Well, Bill Strazzullo is a partner and chief market strategist at Bell Curve Trading, and recently he's changed his tune a little bit. Before, last time he was on with Matt and Carol, he was talking about still getting into the market. Now he talks about harvest mode, very seasonally appropriate phrase to use. Bill, thanks a lot for coming in and joining us. So harvest mode, what changed here? What changed that people should not be looking for the S&P to keep rising right now?
Well, our bigger picture game plan, Julie, really hasn't changed. I mean, I was back on the show in early August. I talked about another leg higher in the S&P to 1100, 1150. And I guess if you had to say what has changed, we're there now. And so if you're somebody with a 3-month or 6-month time horizon or longer, we really feel you should be in the harvest mode, meaning you should be taking your profit, taking a step back, and beginning to unwind your equity exposure, because we feel the March rally is in its late innings. We don't think this is going to be like the period coming out of 2002, 2003 after the dot-com bust, where the market just goes up for 4 or 5 years. So you're getting close to the top here. Take your profit, take a step back.
So what do you think, what are the factors that are limiting this rally, besides just the number? Because
Sure.
Obviously, you know, you say 1100, 1150,
yeah.
It's a number, but what determines that number?
Yeah, that's a good question, Julie. I think what has to happen here for the market to make significant progress from these levels is that the recovery has to transition from one that's been largely public supported, whether it's bailouts, stimulus package, zero interest rates, to one that's organic, where the private sector can generate jobs, the private sector can generate jobs.
Well, if you're talking about private sector job growth, we're not looking at that for quite some time, are we?
Exactly. And that's why I think once this March rally tops out, what you're likely to see is much more of a range, where the upper end's 1100, 1150, fair value comes in around 950, 900, and the lower end 750, 700.
So does that tell you, is the market still vulnerable in your opinion? Do these levels give you comfort right now?
I think at these levels, what we've been telling our clients is that the risk reward really doesn't make sense. And we're not trying to call a high here. I think that's a loser's game. You're right once, you're wrong 1,000 times. But really the challenge is to assess at what point the risk reward shifts. And at these price levels, we feel the risks are at least as great, if not greater, than the potential rewards.
Well, yeah, if you're talking about 750 as the lower end of a range, yeah. That's a pretty big risk from 1100.
And 900 still being, in your opinion, fair value range for the S&P.
Right, exactly. So the point here is that, look, most people who are watching the show, they got crushed in 2008. They saw their IRAs or 401ks down 40, 50, 60%. 2009, they saw a nice bump, a nice recovery. What do you do at this stage of the game? That's, you know, for the typical person watching the show. And what we feel is that you should be moving some of your assets into something safe like cash, maybe, you know, 30, 40%. That way, if we're wrong and the market continues higher, you can participate in the upside. But if we do top out here, at least you've protected some of your gains.
I got to bring up gold also.
Yeah.
You know, obviously it keeps going to record after record, but everyone loves it. So when everyone loves it, does that make you nervous?
No, it doesn't, Julia. Look, we've been bullish for a long time here. I think gold is going to 1,400. If you ask the question, okay, if we are in kind of a sideways range mode once this March rally ends, where are there opportunities? And we like the precious metals a lot. I think silver can trade to $22 an ounce. I think gold's going to 1,400. And so there's a place where not only can you have some nice upside, but also hedge the weaker dollar.
I was going to say, Ben, speaking of the dollar weakness and how it's affecting other asset classes, you mentioned earlier in this fall, you said you warned about taking a path which could lead to what you call the U.S. devaluing its way to prosperity. Do you still see that? Did you hear anything, perhaps, from what U.S. officials were saying during the president's visit to China and overseas that maybe allayed some of your concerns?
Well, the point is this, is that the weaker dollar has definitely been a boost to the stock market. But at some point, that story plays itself out. At some point, you start to turn off foreign investors from putting money in our stock market, our bond market, et cetera. And really, the bigger issue here is, as I said, there's never been a country in the history of the world that's devalued their way to prosperity. At some point in time, we've got to get our financial house in order, and we've got to have some support for the dollar. I don't think you're going to see it anytime soon in terms of higher interest rates, and as long as that's the case, the commodities probably continue to do well.
Well, that's what I was going to say. When the dollar starts to strengthen again, can gold go up at the same time?
Well, I still think you can have gold strength. I don't think that the weak dollar is one of the drivers. I don't think it's the only driver. If we're right here about the markets topping out, I do think there'll also be an aspect to the gold bid that's going to have to do with just the safe haven part of the trade as well.
When's the time to get back into financials?
Good question, Mark. Look, I think there are two issues when it comes to financials. One is the balance sheet side of the equation. The other is the income statement side. On the balance sheet side of the equation, I think we're okay in the sense we know the government's going to backstop the big banks. Not all banks, the big banks, in terms of their troubled assets.
Do you think they still need it right now?
As long as the real estate markets are weak, they absolutely do need it. So but I do think the government will come in and backstop on the balance sheet side. The problematic side is the income statement side. How are these firms going to make money on an ongoing basis when they're going to more than likely be more heavily regulated, have less people, their markets that they're going to be able to make profit from? There's a lot fewer opportunities. So I think it's going to be difficult going forward.
Well, we had Pennsylvania Congressman Paul Kanjorski telling Julie earlier this afternoon, too big to fail means too big.
Exactly. I mean, look, I think that...
Is there a danger of over-regulation there?
Good question, Mark. I think what you're seeing now is the pendulum swing. I mean, we went from, one side where it seemed like it was the wild, wild west, and my fear here is that the pendulum is going to swing the other way, where we overregulate and limit the profit potential of our financials.
So just to get real quickly, we only have a few seconds left. So you talked about the XLF, the financial ETF, last time. So it sounds like you still should be cautious on it.
Well, we had been bullish for a while. I talked about it in early August. We looked for a move to 15, and I said, look, I think you even have the potential to go to 17, 18. It's kind of stalled out. Right now, it'd really be more neutral.
Okay. Bill Strazzullo, Bell Curve Trading, thanks a lot for coming in.
So
we'll be right back.
My pleasure.